There's a photograph of a young man, barely a teenager, standing proudly next to a gleaming, dark-colored pinball machine. His smile isn't just one of youthful joy, it's the quiet, confident smile of a proprietor. The young man is Warren Buffett, and the year is 1946. This wasn't a toy his father bought for him. It was a business. He had observed his friends and the world around him, discovering a simple truth. People will pay a small amount of money for a moment of distraction, a small thrill. He saw the nickels and dimes dropping into other people's machines and did the math. A used pinball machine cost $25. He didn't have $25. For most people, the story would end right there. The dream would collide with the reality of an empty pocket, and that would be that. The common solution, the one whispered in our ears from the moment we understand commerce, is to borrow. Go to a parent, a friend, an institution, and get the money. Pay them back later. It's the American way. But Warren Buffett, even then, was not most people. He proposed a partnership to his friend Don Danley. Buffett would provide the expertise, the idea, the hustle. Don would provide the capital. It was a joint venture, a sharing of risk and reward. They bought the machine, and Warren, using his grandfather's grocery store as a testing ground, found a friendly barber named Frank Einefold, who agreed to house the machine in his shop. The deal was simple. They would split the profits. Every evening, Warren and Don would go to the barber shop, open the back of the machine, and count the coins. It was a symphony of success, the clinking of metal a testament to their simple, brilliant idea. The first machine, a Wilson model, was so successful that they soon had enough money to buy another, and then another. Within a few months, this small pinball empire was generating $50 a week in profit, a staggering sum for a teenager in the 1940s. He had built a business, generated cash flow, and expanded his operations, all without borrowing a single penny. He had used partnership, ingenuity, and reinvested profits, but never debt. This small story, a footnote in the grand legend of the Oracle of Omaha, is not just a charming anecdote. It is the genetic code of his entire philosophy. It's the foundational principle upon which the $90 billion fortress of Berkshire Hathaway was built. The absolute, unshakable, deeply ingrained aversion to borrowing money. He has said, time and again, that there are only three ways a smart person can go broke: liquor, ladies, and leverage. The first two, he jokes, he can't comment on. But the third, leverage, he has treated as a financial plague his entire life. To understand Buffett, you must first understand this core belief. It's not just a preference, it's a commandment. In a world that screams at you to use other people's money to get rich, that sells you on credit cards, mortgages, car loans, and business lines of credit as the tools of prosperity, Buffett's life is a testament to a different path. It is a path of patience, of prudence, and of prioritizing one single thing above all else: survival. Because the one thing debt always does, no matter how clever you are, no matter how favorable the terms, is introduce a risk of ruin. It puts the gun in someone else's hand. And for a man whose entire strategy is based on compounding wealth over an entire lifetime, the possibility of ever going back to zero is not just a bad outcome. It is the only outcome that is completely and totally unacceptable. This story of the pinball machine is the first chapter in a lifelong masterclass on avoiding debt, a lesson that is more critical today than ever before. It's a lesson in building true, resilient financial freedom, not the fragile illusion of wealth that so many chase. We are going to deconstruct this philosophy, piece by piece, from his personal habits to the core of his corporate strategy. And then, we will unveil the one spectacular exception to his rule, the one form of borrowed money he not only uses but actively seeks out, the one secret ingredient that has fueled the Berkshire Hathaway engine for over 50 years. Understanding this paradox is to understand the very heart of the smartest money in the world. Let's begin with the man himself, long before the billions, before the fame, before Berkshire Hathaway. The foundation of Buffett's aversion to debt wasn't forged in a boardroom or a business school classroom. It was forged in the crucible of the Great Depression through the eyes of his father, Howard Buffett. Warren was born in 1930, just as the financial world was collapsing. His father, a stockbroker, saw firsthand how fortunes built on the shaky stilts of leverage were utterly annihilated. Men who were titans of industry one day were wiped out the next, not because their businesses were bad, but because they had borrowed money to buy stocks, and when the market turned, their lenders called in the loans. They were forced to sell at the absolute worst time, locking in catastrophic losses. This concept, the margin call, was a recurring nightmare in the Buffett household. It was the boogeyman that haunted the dinner table conversations. Young Warren absorbed this lesson into his very being. When you borrow money, you give someone else the power to decide your fate. You are no longer in control. This was a lesson his father, Howard, took to heart. After his brokerage firm went under, he started his own, Buffett Falk & Co. He ran it with an almost religious commitment to financial conservatism. He despised debt. He believed in tangible assets, in cash, in owning things outright. This environment shaped his son's worldview more than any book or lecture ever could. But the most powerful foundational anecdote of Buffett's personal philosophy on debt comes a bit later, in the early 1950s. After studying under the legendary Benjamin Graham at Columbia University, the father of value investing, Buffett returned to Omaha. He was brimming with ideas, with a system for finding undervalued companies that he knew with mathematical certainty would work. He was ready to start his own investment partnership. He approached the people who trusted him most, his family and close friends. He went to his father-in-law, his Aunt Alice, his college roommate. He asked them to entrust him with their savings. But he did something that seems almost unbelievable by today's standards of high finance. He put in nearly all of his own money, about $100,000, which was his entire net worth at the time. But more importantly, he refused to use any leverage in the partnership. No margin loans, no borrowing to juice the returns. His partners, some of whom were sophisticated investors, likely questioned this. Standard practice even then was to use some degree of leverage to amplify gains. If you were confident in your picks, why wouldn't you borrow to buy more? Buffett's answer was simple and profound. He told them that his primary goal was not to generate the absolute highest return possible in any given year. His goal was to ensure they never had a catastrophic loss. He was playing a long game, a game of compounding. And the enemy of compounding is interruption. A single terrible year, a year where you are forced to sell assets to meet a margin call, can wipe out a decade of progress. He made a promise to his partners, a promise that was both a marketing pitch and a sacred vow. He would not expose their capital, or his own, to the one thing that could take them out of the game entirely. He would rather accept a good return he could count on, year after year, than chase a spectacular return that came with even a small risk of total ruin. This wasn't just a strategy, it was a deeply personal moral code. He felt the weight of his Aunt Alice's life savings on his shoulders. He felt the trust of his friends. To gamble with that trust by using leverage would have been, to him, a betrayal. From 1956 to 1969, the Buffett partnership delivered an average annual return of nearly 30%. Absolutely crushing the market, all without using any meaningful debt. He proved that genius and discipline were far more powerful than leverage. This story reveals the psychological bedrock of his entire life, the prioritization of uninterrupted compounding above all else. So what is the deep psychological principle at play here? Why is Buffett's brain wired so differently from the average person who eagerly signs up for a new credit card or takes out a home equity loan to fund a vacation? The answer lies in a cognitive bias known as hyperbolic discounting, or more simply, time inconsistency. Our brains are wired for immediate gratification. We value a reward today far more than a larger reward in the future. A marshmallow now is better than 2 marshmallows in an hour. This is the classic experiment. Similarly, we discount future pain. The discomfort of paying an interest charge a month from now feels abstract and distant compared to the immediate pleasure of buying that new television or car today. The entire consumer credit industry is built on exploiting this quirk of human psychology. They make it easy, frictionless, to have what you want right now, and they push the pain of repayment into the future, a future your brain is naturally inclined to undervalue. Buffett's mind operates on the complete opposite principle. He has trained himself, through decades of discipline, to invert hyperbolic discounting. He feels the future pain of an interest payment with more acuity than the present pleasure of a purchase. He doesn't just understand the math of compound interest working against him, he feels it as a visceral threat. When he looks at a loan, he doesn't see a tool for getting something now. He sees a parasite that will latch on to his future earnings, siphoning off a portion of his life's energy, month after month, year after year. This mindset allows him to make a trade that most people find impossible, sacrificing a small, immediate pleasure for a massive, long-term gain. He is willing to live more modestly than his means would allow, to delay gratification, because he understands that every dollar not spent on interest is a dollar that can be put to work for him. It's a soldier in his army, sent out to capture more prisoners, which in turn become more soldiers. Debt does the opposite. It sends your soldiers to work for the enemy, for the bank, for the credit card company. This is a profound rewiring of the brain's natural reward system, a key component of achieving lasting financial freedom. It's about shifting your focus from the short-term thrill to the long-term power of an unburdened balance sheet. How can you or I apply this principle? How do we translate this deeply ingrained psychological discipline into a practical, usable mental model? We can call it the Sleep Well at Night test for personal finance. This is a blueprint for making decisions about debt in your own life, a way to build the same resilience that defines Buffett's personal financial management. It consists of a simple 4-question checklist you must apply to any potential loan, whether it's a mortgage, a car loan, or even just a credit card balance. Question 1. Is this debt for an asset that has a high probability of increasing in value over time? This immediately separates good debt from bad debt. A sensible mortgage on a well-located home can be an acceptable form of leverage because real estate, over the long term, tends to appreciate. The asset is likely to grow while the loan shrinks. A car loan, on the other hand, is almost always for a rapidly depreciating asset. The moment you drive it off the lot, it's worth less than what you owe. Credit card debt used for consumables, dinners, vacations, clothes, is the worst of all. You are paying interest on a memory. The asset is gone, but the liability remains. Question 2. Can I comfortably afford the payments even if my income were to be cut by 30% for 6 months? This is the stress test. It forces you to build a margin of safety into your financial life. Most people calculate affordability based on their current, best-case scenario income. This is incredibly fragile. A job loss, a medical emergency, an economic downturn. These things happen. The Sleep Well at Night test demands that you plan for adversity. If taking on the debt would put you in a panic state after a single missed paycheck, you have no business taking it on. True wealth-building strategies are about resilience, not just returns. Question 3. Does this debt prevent me from saving at least 15% of my pre-tax income for my future? This question addresses the immense opportunity cost of debt. Every dollar you send to a lender in the form of interest is a dollar you cannot invest for your own retirement, for your own financial freedom. Debt payments are a direct tax on your future self. If the monthly payment on a new car or a larger house means you have to cut back on your 401k or IRA contributions, you are making a catastrophic long-term trade for a short-term upgrade in lifestyle. You are literally choosing to work longer and be poorer in retirement. Question 4, and this is the most Buffett-esque of all. If I were paying for this in cash out of my own savings, Would I still feel this purchase is an absolute necessity and a great value? This question cuts through all the psychological games that financing allows us to play. When you can pay just a few $100s a month, a $50,000 car seems attainable. But if you had to walk into the dealership and slide a stack of $50,000 in cash across the table, money you painstakingly saved over years, would it still feel like a good idea? Or would you suddenly start thinking about all the other things that money could do for you, like buy you freedom? This mental model forces you to confront the true cost of your decisions and builds a firewall against the seductive call of easy credit, creating a foundation for debt-free living. Now let's explore the opposite path, the one trodden by the vast majority, the antithesis, the path of the 99%. This is the world of normalized debt, where borrowing is not a last resort, but the default setting for modern life. It begins innocently enough. A student loan, pitched as a good debt, an investment in your future. Then comes the first credit card in college, often with a free t-shirt, a small credit limit that feels harmless. This is the gateway. It teaches a dangerous lesson. You can have what you want now, even if you haven't earned it yet. The brain's reward centers light up, and a habit is formed. After graduation, the cycle accelerates. The pressure to look the part leads to a car loan for a vehicle that's a bit nicer than what one can truly afford. The monthly payment becomes a fixed part of the budget, a permanent fixture of adult life. Then comes the desire for a home. Instead of saving a substantial 20% down payment, which requires years of discipline and delayed gratification, the 99% opt for low down payment loans, like FHA loans, requiring only 3.5% down. This means they start their homeownership journey with very little equity and a much larger loan, leading to higher monthly payments and the added cost of private mortgage insurance. They are immediately highly leveraged. Their largest asset is almost entirely owned by the bank. The lifestyle inflation continues. Credit cards are used to furnish the new home, to take vacations that appear on social media, to dine at restaurants. The balances creep up. Soon, the minimum payment becomes the strategy. People fall into the trap of thinking they can afford something if they can afford the minimum payment, failing to realize they are now in a financial quagmire, paying exorbitant interest rates, often over 20%, which makes it nearly impossible to ever pay off the principal. They are running on a hamster wheel built by the banks. This isn't a portrait of financial irresponsibility. It's a portrait of modern financial normalcy. People aren't dumb. They are following a script that society has written for them. A script that says debt is a tool, that a credit score is a measure of your worth, and that leveraging your future is the fastest way to live a good life today. The consequence is a state of perpetual financial fragility. A single unexpected event, a car repair, a medical bill, a furlough, can shatter the whole illusion. They have no margin of safety. They are one paycheck away from disaster. This is the path of working for your money your entire life, instead of having your money work for you. It's a life sentence of servitude to lenders, a stark and tragic contrast to the freedom and power that comes from owning your life outright. What is the direct financial connection? How does this personal aversion to debt translate into a tangible, massive advantage on a personal balance sheet? Let's quantify the impact. Imagine two individuals, Amy and Ben, both 25 years old, both earning $60,000 a year. Ben follows the path of the 99%. He takes out a $25,000 loan for a new car at a 5% interest rate for 5 years. His monthly payment is about $470. He also carries an average credit card balance of $5,000 at an 18% interest rate, making minimum payments. For the next 5 years, a significant chunk of his income is diverted to servicing these debts. The total interest paid on the car loan alone is over $3,000. The credit card interest is even more destructive. Amy, following the Buffett model, drives a reliable used car she bought for $5,000 in cash. She uses a credit card but pays it off in full every single month, incurring zero interest charges. The $470 a month that Ben sends to his auto lender, Amy invests in a simple, low-cost S&P 500 index fund. Let's assume a conservative 7% average annual return. After 5 years, Ben has a 5-year-old car worth maybe $10,000 and is finally debt-free from that loan. But he has nothing to show for the more than $3,000 he paid in interest. Amy, on the other hand, has her reliable debt-free car and her investment account, where she consistently deposited $470 a month, has grown to over $33,000. This is the initial divergence. Now let's compound it over a lifetime. Amy continues this habit. Every dollar not spent on interest becomes a soldier in her investment army. Ben continues the cycle of debt, moving from one car loan to the next, always having a payment, always carrying some high-interest consumer debt. By age 65, the difference is staggering. Assuming they both get similar raises and promotions, Amy's commitment to avoiding debt and consistently investing could easily result in a net worth that is $1 to $2 million higher than Ben's. That's the price of a lifetime of car payments and credit card interest. It's a multi-million-dollar difference. The financial connection is brutal and mathematical. Debt creates a negative compounding machine that works against you every single day. The interest payments are a guaranteed loss that you must overcome before you can even begin to build wealth. Avoiding debt allows you to turn that machine off and instead start a positive compounding machine that works for you, even while you sleep. It is the single most powerful lever an individual can pull to change their financial destiny. It's the difference between arriving at retirement with a vast fortune and arriving with a Social Security check and a mountain of regrets. This is the foundation, the personal code. Now let's see how Buffett takes this same principle and applies it to the world of high-stakes corporate finance. The year is 1972. Warren Buffett and his partner, Charlie Munger, are looking at a small, family-owned candy company based in California. It's called See's Candies. By the standards of Wall Street, it was an unremarkable business. It was profitable, yes, but it wasn't a high-growth technology company. It was quaint, old-fashioned. They made boxed chocolates. The See family wanted to sell, and their asking price was $30 million. Buffett and Munger looked at the books. The company had about $8 million in tangible assets, factories, stores, inventory. The remaining $22 million of the asking price was for something intangible: the brand, the customer loyalty, the decades of happy memories associated with giving and receiving a box of See's chocolates. At the time, Buffett was still a strict disciple of Ben Graham, who taught him to buy businesses for less than the value of their hard, liquidatable assets. By that measure, See's was wildly overpriced. Munger, however, pushed Buffett to evolve his thinking. He argued that they weren't just buying buildings and inventory, they were buying a durable competitive advantage, a moat around their business that competitors couldn't easily breach. People in California didn't just buy See's because it was good chocolate. They bought it because it was a tradition. They were willing to pay a premium for that quality and consistency. After much deliberation, they agreed to the deal. But the most important part of this story isn't what they bought, but how they bought it. The standard playbook for an acquisition like this, especially in the burgeoning world of corporate takeovers, would have been to use leverage. A firm would borrow a large portion of the $30 million purchase price, using the assets and cash flows of See's Candies itself as collateral for the loan. This is called a leveraged buyout, or LBO. It juices the return on the equity you put in. If the deal works, you make a fortune. But Buffett and Munger refused. They paid the entire $30 million in cash, straight from the coffers of Blue Chip Stamps, one of their holding companies at the time. There was no debt, no loan from a bank, no financial engineering. They simply wrote a check. Why? For the exact same reason Buffett refused to use leverage in his personal partnership. Debt introduces fragility. If they had loaded See's up with debt, the company would have been beholden to its bankers. In a bad year, if there was a sugar price spike or a recession that hurt sales, the pressure to make those interest payments could have forced them to make terrible decisions. They might have had to cut corners on ingredients, cheapening the product that was the very source of their brand's power. They might have had to lay off experienced candy makers, hurting quality. They might have had to skip investments in new stores or equipment, mortgaging the future to survive the present. By paying cash, they gave See's management one simple instruction: focus on making the best possible product and protecting the brand. They liberated the company from the tyranny of the lender. See's candies went on to become one of the greatest investments in history. That initial $30 million investment has since generated over $2 billion in cash for Berkshire Hathaway, money that was then redeployed to buy other great businesses. It became the prototype for the Berkshire acquisition model: buy wonderful businesses with durable competitive advantages at a fair price using cash. This simple, powerful story stands in stark contrast to the debt-fueled mania of modern corporate finance. It is a testament to the idea that prudence, not leverage, is the true engine of long-term corporate value creation. The psychological principle underpinning this corporate strategy is the deliberate avoidance of two powerful and often destructive cognitive biases: overconfidence bias and the related fear of missing out, or FOMO. In the world of corporate executive decision-making, CEOs and boards are under immense pressure to grow, to do deals, to make headlines. They look at a potential acquisition, and their natural optimism takes over. They create financial models that project rosy future cash flows, synergies that always seem to materialize on spreadsheets but rarely in reality, and a smooth, uninterrupted path to success. This is overconfidence bias in action. They believe, with sincere conviction, that their plan cannot fail. Because they are so confident in this bright future, using leverage seems like a no-brainer. Why use your own cash when you can use the bank's money to magnify your brilliant success? Debt becomes the fuel for their ambition. Compounding this is FOMO. A rival company makes a big, splashy acquisition. Investment bankers are constantly on the phone, pitching transformative deals. The board gets restless. The narrative becomes, "We have to do something, or we'll be left behind." This fear of being seen as stagnant or timid drives companies to chase deals they otherwise wouldn't, often paying too much and using too much debt to get it done. The discipline of a cash-only approach acts as a powerful antidote to both of these biases. When you have to pay for an entire company with your own hard-earned cash, it forces a different level of scrutiny. The question is no longer, can we make the monthly payment, but rather, is this business so good, so durable, that we are willing to trade a massive pile of our irreplaceable cash for it? This cash-only constraint imposes a brutal intellectual honesty on the decision-making process. You can't fool yourself with fancy financial models when you see the money actually leaving your bank account. It tempers overconfidence. It also short-circuits FOMO. Buffett is famous for his ability to sit on enormous piles of cash for years, waiting for the perfect pitch. He feels zero pressure to do something just because others are. His mantra is patience. The cash in his pocket is his power. It allows him to be the one calm person in a room full of panicked, over-leveraged players during a market downturn. By refusing to dance to the tune of debt-fueled ambition, he avoids the manic highs and the catastrophic lows of the deal-making cycle. This psychological fortitude, this immunity to the siren song of leverage and hurry, is a critical component of Berkshire Hathaway's long-term success. It's a corporate culture of risk management that starts with saying no to the easiest and most tempting tool in the corporate finance toolbox. So how can we apply this corporate prudence to our own investments or business decisions? We can create a mental model called the Cash Flow Coverage Blueprint. This is a simplified, Buffett-style framework for analyzing the debt load of any company you might want to invest in, or for making financing decisions in your own business. It's a way to cut through the noise of complex accounting and focus on what really matters: resilience. The blueprint has 3 steps. Step 1. Find the owner's interest coverage ratio. Don't just use the standard interest coverage ratio that accountants use. We need to be more conservative. First, find the company's operating income, or EBIT, earnings before interest and taxes, on the income statement. This represents the profit from the core business operations. Then, look at the cash flow statement. and subtract the average annual capital expenditures, or CapEx. This is the money the company must spend on maintaining its factories and equipment just to stay in business. The result is what Buffett calls owner earnings, the true cash profit available to the owners. Now, divide this number by the company's annual interest expense. The result is your owner's interest coverage ratio. A healthy, resilient company should have a ratio of at least 5 to 1. This means for every $1 it owes in interest, it is generating $5 in true cash profit to cover it. Many companies operate with ratios of 2 or 3, which is a sign of fragility. Step 2. Check the debt-to-equity ratio, but with a twist. The standard debt-to-equity ratio on a balance sheet can be misleading because of accounting conventions like goodwill. We want a more tangible measure. Take the company's total debt, both short-term and long-term, and divide it by the company's tangible book value. Tangible book value is the total equity minus any intangible assets like goodwill. This gives you a much clearer picture of how much hard, physical asset value is backing up the company's debt. A ratio below 0.5 is generally very safe. A ratio above 1.0 means the company owes more to its creditors than the tangible value of its assets, which is a major red flag. Step 3. Read the covenants section in the annual report. This is the part most investors skip, but it's where the real risk lies. Loan covenants are the rules and conditions that a company must follow to keep its loans in good standing. These can include things like maintaining a certain level of profitability or not letting their debt ratio exceed a certain threshold. If the company violates a covenant, perhaps during a minor recession, the lender has the right to demand immediate repayment of the entire loan. This is the corporate equivalent of a margin call. It can force an otherwise healthy company into bankruptcy. Look for companies with very few, very loose covenants, or even better, very little debt to begin with. By using this 3-step blueprint, you start to see companies through Buffett's eyes. You prioritize businesses that are financed, like fortresses, not like fragile houses of cards. You are conducting your own form of risk management, ensuring that your investments can withstand the inevitable storms of the economic cycle, a cornerstone of any successful long-term wealth-building strategy. Now, let's examine the antithesis, the dominant force in modern corporate finance, the leveraged buyout, or LBO. This is the path of the 99% in the world of high-stakes business. It's the model perfected by private equity firms, and it is the philosophical opposite of the Berkshire Hathaway approach. Here's how it works. A private equity firm identifies a target company, often a stable, cash-generating business, similar to what Buffett might like. But instead of buying it with their own cash, they put down a very small sliver of equity, maybe 10 to 30% of the purchase price. The remaining 70 to 90% is borrowed from banks and bondholders. And here's the crucial part. The debt is placed directly onto the balance sheet of the company being acquired. The acquired company is now responsible for paying back the money that was used to buy it. This is a brilliant move for the private equity firm. They have control of a large company while risking very little of their own capital. If things go well, the returns on their small sliver of equity are magnified enormously. A 10% increase in the company's value could translate into a 100% return on their investment. But what about the company itself? It is now saddled with a crushing amount of debt. The pressure to make those huge interest payments is immense. This forces a series of predictable and often destructive actions. First, aggressive cost-cutting. This often means massive layoffs, reduced research and development, and delayed maintenance on critical equipment. The long-term health of the company is sacrificed for short-term cash flow to service the debt. Second, assets are often sold off. Profitable divisions or valuable real estate might be liquidated to pay down the loan, breaking up a once cohesive business. Third, the firm often pays itself huge management or monitoring fees, extracting cash from the company regardless of its performance. If the strategy works, the private equity firm typically aims to sell or take the company public again within 3 to 5 years, cashing out for a massive profit. But if there's even a small hiccup, a recession, a new competitor, a shift in consumer tastes, the model collapses. The company, starved of investment and burdened by debt, can't adapt. It can't weather the storm. It defaults on its loans and is forced into bankruptcy. We've seen this story play out time and time again with beloved retail chains, manufacturing companies, and newspapers. A healthy, if unspectacular, business is taken over, loaded with debt, and then hollowed out until it becomes a shell of its former self. The private equity partners walk away wealthy, while the employees, customers, and the company itself are left in ruins. This is the danger of prioritizing leveraged returns over operational health. It's a model that privatizes the gains and socializes the losses, a stark and brutal illustration of the disastrous consequences of ignoring Buffett's prudent, cash-focused philosophy. Let's trace the direct financial connection and see how this corporate prudence creates a tangible advantage on the balance sheet. We can compare the financial statements of a typical Berkshire Hathaway subsidiary, let's say BNSF Railway, with a hypothetical LBO-owned competitor, Leveraged Rail. BNSF, under Berkshire, carries a very manageable level of debt. Its balance sheet is fortress-like. A huge portion of its assets are funded by equity, the permanent capital provided by Berkshire. Let's say its debt-to-equity ratio is a conservative 0.4. Its interest coverage ratio is a sky-high 10x. It generates massive, predictable cash flows, and after reinvesting what's needed to maintain its vast network, the excess cash is sent up to Omaha to be redeployed. Now look at Leveraged Rail. After its LBO, its balance sheet is a mirror image. Its debt-to-equity ratio is 4.0. 90% of its capital structure is debt. Its interest coverage ratio is a precarious 1.5x. Almost every dollar of cash flow it generates is immediately consumed by interest payments. Now let's introduce a shock to the system. A severe recession hits. Shipping volumes plummet by 20% across the industry. For BNSF, this is painful but not life-threatening. Its revenues drop, and its profits decline. But because its interest payments are so small relative to its earnings, it remains comfortably profitable. It can continue to invest in safety upgrades and track maintenance. It might even take advantage of the downturn to buy smaller, distressed competitors at bargain prices. It can play offense while everyone else is playing defense. For Leveraged Rail, the same 20% drop in revenue is a death blow. Its operating income is slashed, and its interest coverage ratio drops below 1. It is no longer generating enough cash to cover its interest payments. It violates its loan covenants. The lenders panic. They can force the company into bankruptcy, seize its assets, and wipe out the equity holders. The very same external shock that was a manageable problem for BNSF becomes an existential crisis for Leveraged Rail. The difference is not the quality of the railroad, it's the quality of the balance sheet. This is the tangible financial advantage of Buffett's approach. It's not about earning a slightly higher return in the good years. It's about guaranteeing survival and having the financial firepower to prosper during the bad years. The bad years are when the real money is made, when fortunes are transferred from the fragile to the resilient. By avoiding leverage, Buffett ensures that Berkshire Hathaway is always the one holding the checkbook when the world is on sale. For decades, this was the complete story. Warren Buffett despises debt. He avoids it in his personal life. He avoids it in his corporate acquisitions. The lesson seems simple. Debt is a four-letter word to be avoided at all costs. But this is where the story takes a fascinating and brilliant turn. Because there is one form of debt, one special type of borrowed money, that Buffett not only accepts, but has actively sought out his entire career. It is the secret fuel, the jet engine, at the core of Berkshire Hathaway's incredible compounding machine. And to understand it is to graduate to a new level of financial education. The story begins in 1967. Buffett was still running his partnership and managing the textile mill, Berkshire Hathaway, which was a struggling business in a dying industry. He was looking for a place to invest the company's small profits. Through a connection in Omaha, he learned about two small private insurance companies for sale, National Indemnity Company and a smaller affiliate. The owner, Jack Ringwalt, was an eccentric but brilliant businessman who had built a solid, profitable enterprise. Insurance was a business Buffett understood intuitively from his studies of Ben Graham. He saw something in the numbers that most people overlooked. He agreed to buy National Indemnity for $8.5 million. It was a pivotal moment, perhaps the single most important acquisition in Berkshire's history. Not because the insurance business itself was a goldmine of profit, but because of what it came with: float. What is float? In simple terms, insurance companies collect premiums from customers up front. You pay your car insurance premium today, but you might not have an accident for months or even years. In the time between when the insurer collects the premium and when they might have to pay out a claim, they hold on to your money. This pool of money, this collected premium that has not yet been paid out in claims, is called float. From an accounting perspective, float is a liability. It's money that the insurance company owes to its policyholders in the future. It is, in essence, a form of borrowed money. But it is the most wonderful kind of borrowed money imaginable. And this is the genius that Buffett recognized. First, unlike a traditional loan from a bank, float has no fixed repayment date. As long as the company keeps writing new policies, there's a constant revolving pool of money. New premiums come in as old claims are paid out. If the business is run well and grows, the amount of float tends to increase over time. Second, it has no restrictive covenants. There is no banker telling you what you can and can't do with the money. As long as you maintain enough capital to pay claims, you have enormous flexibility. But here is the most magical part. The part that makes it the best debt in the world. It often has a negative interest rate. If an insurance company is good at underwriting, that is, assessing risk and charging the appropriate premium, it can make a profit on its operations. A well-run insurer might collect $100 in premiums for every $95 it pays out in claims and expenses. This $5 difference is called an underwriting profit. In this case, not only do you get to hold and invest the float for free, you actually get paid to hold it. You are being paid to borrow money. This was the revelation. Buffett realized that if he could acquire insurance companies that were run by disciplined underwriters, he could gain access to a permanent, ever-increasing pool of capital that was not just free but better than free. He could then take this float and invest it for Berkshire Hathaway's benefit in stocks, bonds, and outright ownership of other businesses. The profits from those investments would belong entirely to Berkshire shareholders. This was the masterstroke. The acquisition of National Indemnity was the moment Buffett found the engine for his vehicle. The struggling textile mill would become the holding company, and the float from its insurance subsidiaries would be the high-octane fuel that would power its journey for the next 50 years. The underlying psychological principle at play here is the mastery of asymmetric risk and reward. Most people, when they think about leverage, are faced with a symmetric or even negatively skewed proposition. When you take out a business loan, the upside is that your business might succeed, and you'll make a profit. The downside is that if it fails, you could lose everything and be personally liable for the debt. The potential for ruin is significant. When you buy stocks on margin, your potential gain is magnified, but so is your potential loss. A 20% drop in the stock price could lead to a 100% loss of your capital. The risk is symmetric to the reward, and because of the mechanics of a margin call, it's often skewed against you. Buffett, with his deep-seated aversion to any risk of ruin, instinctively rejects these propositions. He is not looking for a 50-50 bet, even if the payoff is high. He is searching for situations where the odds are overwhelmingly stacked in his favor. He wants a heads I win, tails I don't lose much scenario. Insurance float is the ultimate asymmetric bet. Let's analyze the risk/reward profile. The upside is spectacular. You get a massive long-term pool of capital to invest. If you invest it wisely, as Buffett has, you can generate billions of dollars in gains. The profits from investing Berkshire's float are the primary driver of its legendary returns. The downside, however, is remarkably contained, provided you do one thing right: underwrite profitably. If your insurance subsidiaries consistently generate an underwriting profit, the worst-case scenario for the float itself is that it shrinks slightly in a given year. But there is no lender who can call the loan. There is no interest payment that you might miss. The risk of a margin call on the float itself is virtually non-existent. The primary risk shifts from financial risk, debt covenants, interest payments, to operational risk, assessing insurance risks correctly. This is a trade Buffett is delighted to make. He knows he can't predict the stock market or the economy, which is why he hates financial leverage. But he can control the quality of the insurance businesses he buys and the discipline of the managers he puts in charge. He is trading an uncontrollable external risk for a controllable internal one. This is a profound insight into the mind of a master risk manager. He isn't avoiding risk. He is choosing his risks with incredible precision. He is avoiding the bad risks of leverage that can lead to ruin and embracing the good risks of business operations that he understands and can control. This ability to identify and structure asymmetric payoffs is a core tenet of his genius, and the psychological key to understanding why he embraces this one specific form of debt while shunning all others. It solves the problem of needing capital to grow without introducing the poison of potential ruin. How can an ordinary person or a small business owner apply this abstract concept of float? While you can't go out and buy a multi-billion-dollar insurance company, you can adopt the float-like structures mental model to improve your own financial resilience and growth potential. The goal is to identify and create sources of capital in your life or business that share the key characteristics of float. They are low-cost, flexible, and long-term. Here is a blueprint for finding your own float. For an individual, the most powerful float-like structure is simply a high savings rate. Think about it. When you save 20, 30, or even 50% of your income, you are building a pool of your own capital. This is money you owe to your future self. It functions like float. It's available to be invested for the long term. It has no interest cost, it has no covenants. And it provides immense flexibility. It allows you to seize opportunities, like a stock market crash or a real estate deal, without having to borrow from a bank. It provides a massive buffer against life's emergencies, protecting you from having to take on high-interest debt when disaster strikes. Your personal savings are your personal float. For a small business owner, the search for float is about creative business model design. Step 1. Analyze your cash conversion cycle. How long does it take from when you pay your suppliers to when you get paid by your customers? The goal is to shorten this cycle or even make it negative. A negative cash conversion cycle means your customers pay you before you have to pay your suppliers. You are effectively being given a short-term, interest-free loan by your suppliers and customers. This is business float. Companies like Amazon and Costco have mastered this. They sell their inventory and collect cash from customers weeks or even months before they have to pay their own vendors. That difference is a massive pool of free capital they can use to fund their growth. Step 2. Explore customer-funded business models. Can you get your customers to pay you up front for a product or service you will deliver later? This includes things like annual subscription models instead of monthly ones. Offering a small discount for annual payment can generate huge upfront cash. Selling gift cards. A gift card is an interest-free loan from a customer until they redeem it, or requiring customer deposits for large custom projects. All of these are forms of float. They provide you with working capital that is cheaper and more flexible than a traditional bank loan. By constantly thinking, how can I get paid sooner and pay my own bills later, or how can I get my customers to fund my operations, you are internalizing the core lesson of Berkshire's insurance strategy. You are engineering a business that is not just profitable, but self-funding and incredibly resilient. This is a powerful shift from a mindset of seeking debt to a mindset of generating internal float. Let's examine the antithesis. What do the 99% of businesses do when they need capital? They go down the well-trodden path of expensive, restrictive, traditional financing. This is the path of the conventional business loan. A typical small business owner, needing money to expand or cover a shortfall, goes to a bank. They are forced to put together an extensive business plan and often have to pledge personal assets, like their own home, as collateral. They are at the mercy of the loan officer. If they are approved, the loan comes with a host of downsides that stand in stark contrast to the beauty of float. First, it's expensive. The interest rate on a small business loan can be substantial, immediately creating a hurdle that the business must overcome just to break even on the investment. This interest expense is a permanent drag on profitability. Second, it's restrictive. The loan will come with a thick stack of covenants. The business might be required to maintain certain financial ratios, be restricted from making certain investments, or even have limits placed on the owner's salary. The banker is now effectively a silent and very powerful partner in the business. The owner's freedom to operate is compromised. Third, it's inflexible. The loan has a fixed repayment schedule. The business must make the same payment every single month, regardless of whether it was a great month or a terrible one. During a seasonal slump or an unexpected downturn, this fixed payment can become an anchor that pulls the entire enterprise under. For early-stage companies, the alternative is often venture capital. While not technically debt, it often comes with punitive terms, where founders give up large chunks of ownership and control in exchange for capital. They are put on a treadmill of hypergrowth, forced to chase massive outcomes to satisfy their investors, often at the expense of building a sustainable, long-term business. The 99% of businesses see capital as something you get from the outside. They are capital seekers. The Buffett model, the float model, is about designing a business that generates capital from the inside. It's a fundamental difference in philosophy. The conventional path leads to a business that is fragile, beholden to outsiders, and constantly stressed by the demands of its lenders. The float path leads to a business that is resilient, independent, and in control of its own destiny. The consequences of choosing the wrong path are the reason why so many businesses fail, not because their idea was bad, but because their financial structure was weak. The direct financial connection of using float as an engine is perhaps the most astounding financial story of the last century. Let's quantify the advantage Berkshire Hathaway has enjoyed. We can compare the cost of Berkshire's float to the cost of traditional corporate debt. Over the last several decades, Berkshire's float has grown from a few $1,000,000 to over $160 billion. That's $160 billion of other people's money that Warren Buffett gets to invest for Berkshire's benefit. Now, let's consider its cost. Because Berkshire's insurance companies are, on average, exceptionally well run, they have consistently generated an underwriting profit. This means the cost of their float has not been zero. It has been negative. Let's say over the long term, they've achieved an average underwriting profit of 2%. This means they are being paid 2% per year on that $160 billion. They are being paid over $3 billion a year for the privilege of holding this capital. Now compare this to a typical large corporation that needs to raise capital. They would have to issue corporate bonds. A high-quality company might pay, let's say, 5% interest on its bonds. So, to borrow $160 billion, that company would have to pay $8 billion a year in interest. Berkshire, on the other hand, is being handed $3 billion. The difference between these two scenarios is an $11 billion a year advantage for Berkshire Hathaway. $11 billion. Every single year. This is the tangible, staggering power of the float engine. It's not a small accounting trick. It is a fundamental structural advantage that no other company in the world has on this scale. This float-to-value pipeline is the core of the Berkshire Hathaway business model. The float is generated by the insurance operations. Buffett and his team then take that capital and allocate it, buying stocks like Coca-Cola and Apple, or acquiring entire businesses like BNSF Railway and See's Candies. These assets then generate their own earnings and dividends, which flow back to Berkshire, increasing its equity. As Berkshire's equity and financial strength grow, its insurance companies are able to write even more policies, attracting even more float. This creates a powerful, self-reinforcing feedback loop, a concept we can call the capital allocation flywheel. The float buys assets, the assets generate profits that strengthen the company, and a stronger company can generate more float. It is a perpetual motion machine of wealth creation, and it all starts with that one brilliant insight: finding a source of borrowed money that is not just free, but profitable. This brings us to the final, grand synthesis. We've seen the personal philosophy, the corporate prudence, the dangers of leverage, and the genius exception of float. Now we must see how these pieces combine to create the unstoppable empire that is Berkshire Hathaway. The float engine in action is not just a historical account, it's a demonstration of how a core principle, applied with discipline over decades, can produce results that defy imagination. The foundational anecdote for this pillar isn't a single event, but a continuous process of capital allocation that defines the modern era of Berkshire. Consider the period following the 2008 financial crisis. The world was in a state of panic. Credit markets were frozen. Companies that had relied on debt to fund their operations were suddenly cut off. Lehman Brothers, a 158-year-old institution, had collapsed under the weight of its own leverage. Others, like Goldman Sachs and General Electric, were teetering on the brink. They were desperate for capital, for a stamp of approval from a trusted source. And who was the only one with a fortress balance sheet and tens of billions of dollars in ready cash? Warren Buffett. During the depths of the crisis in October 2008, Buffett invested $5 billion in Goldman Sachs. This wasn't a simple stock purchase. He bought preferred stock that paid him a staggering 10% dividend, that's $500 million a year in cash, and he also received warrants to buy Goldman stock at a very low price in the future. Goldman agreed to these harsh terms because they had no other choice. They needed the cash and, more importantly, the, quote, Buffett seal of approval to calm the markets. Where did that $5 billion come from? It came from the float. It was the collected premiums from Geico, National Indemnity, and Berkshire's other insurance operations. While other investors were being wiped out by margin calls and forced selling, Buffett was using his float to make the investment of a lifetime. He was the lender of last resort to the financial world, charging enormous interest for the privilege. He did the same with General Electric, investing $3 billion on similarly favorable terms. A few years later, he would provide a multi-billion-dollar lifeline to Bank of America. In each case, the dynamic was the same. A leveraged world had panicked, and the one unleveraged player was able to calmly step in and name his price. This is the ultimate payoff of his lifelong philosophy. His aversion to debt didn't just help him survive the storm, it positioned him to become the master of it. The float provided the ammunition, and his decades of discipline provided the courage to act when others were paralyzed by fear. The profits from these crisis-era deals were in the tens of billions of dollars. That profit was then added to Berkshire's permanent capital base, further strengthening its balance sheet, allowing its insurance companies to write even more business, generating even more float, and making the flywheel spin even faster. This is the engine in its full, terrifying glory. It is the culmination of a life spent avoiding the siren song of easy credit, and instead building a machine that runs on the world's best form of debt. The deep psychological principle that allows this engine to function at such a scale is the mastery of what is known as the flywheel effect. Popularized by business author Jim Collins, the flywheel concept posits that great companies are not built by a single, brilliant move or a dramatic, revolutionary breakthrough. Instead, they are built by a relentless, disciplined pushing of a giant, heavy flywheel. In the beginning, it takes enormous effort to get it to move even a single inch. The progress is slow, almost imperceptible, but with consistent effort in a single direction, the flywheel begins to build momentum. Each push builds on the last. It starts to turn faster and faster. Eventually, the flywheel's own weight and momentum begin to work for you. It spins with unstoppable force, crushing anything that gets in its way. This is the perfect metaphor for the Berkshire Hathaway business model. The early pushes were the first insurance acquisitions and the initial, small pools of float. Buffett and Munger had to work incredibly hard to find good businesses to buy with that limited capital. But with each successful acquisition, like See's Candies or the Nebraska Furniture Mart, the flywheel gained mass and speed. These companies produced cash, which was sent to Omaha. That cash, combined with new, larger amounts of float from the growing insurance businesses, allowed for bigger and better acquisitions. Buying BNSF Railway was a massive push on the flywheel. Acquiring Precision Castparts was another. Investing tens of billions in Apple was another. Each move adds more energy to the system. The insurance operations generate float. Push 1. The float is invested in stocks and wholly owned businesses. Push 2. Those businesses generate earnings and dividends. Push 3. Those earnings increase Berkshire's capital base, allowing the insurance companies to take on more risk and generate even more float. Push 4, which is the same as push 1 but stronger. It's a closed loop, a self-reinforcing cycle of growth. This requires a psychological makeup that is vanishingly rare in the corporate world. It requires an incredibly long time horizon. A CEO focused on quarterly earnings would never have the patience to build a flywheel. They would look for shortcuts, for leverage, for a splashy deal to impress Wall Street in the short term, which often ends up throwing the flywheel off its axis. Buffett's genius is not just in designing the flywheel, but in his psychological discipline to protect it, to keep pushing in the same direction, decade after decade, without deviation. He is a master of patient, relentless, focused energy, and the result is the most powerful compounding machine the business world has ever seen. How can we apply this grand concept of the flywheel to our own financial lives or smaller businesses? We can build a personal capital allocation flywheel. This mental model translates Berkshire's corporate strategy into a scalable blueprint for building personal wealth. It's about creating a system where your money works to build momentum, leading to a state of what some call financial escape velocity. Here's the 4-stage blueprint. Stage 1, the cash generation engine. This is your primary source of income, your job, or your main business. Your first and most important task is to make this engine as efficient and powerful as possible. This means investing in your skills, negotiating for higher pay, or optimizing your business for profitability. At this stage, you must also ruthlessly follow the principles from our first pillar. Avoid bad debt like the plague. Every dollar not spent on interest is a dollar that can be used to start spinning your flywheel. Your goal here is to create a significant gap between what you earn and what you spend. This gap is your investable capital. Stage 2, the low-cost investment hub. This is where your surplus capital goes to work. For most people, this will be a set of low-cost, diversified index funds within tax-advantaged accounts, like a 401k or a Roth IRA. The key here is consistency and automation. You set up automatic transfers from your bank account every single payday. You are not trying to be a stock-picking genius. You are simply buying a piece of the entire economy, month after month, without fail. This is the first push on your flywheel. It's slow at first. The initial returns are small, but you are building the core of your wealth. Stage 3, the profit reinvestment loop. As your investments grow, they will start to generate their own returns in the form of dividends and capital gains. The critical rule of the flywheel is that all of these returns must be automatically reinvested. Dividends are not for spending. They are for buying more shares of the fund. This activates the power of compounding. Your investment hub is now starting to spin on its own, with your new contributions being supplemented by the hub's own internal momentum. Stage 4, the strategic capital deployment. This is the advanced stage, the true Buffett stage. Once your investment hub has reached a critical mass, say a few $100,000, you can begin to think like a capital allocator. You have a significant pool of capital that gives you options. You might use a portion of it to acquire a cash-flowing asset, like a rental property. The rental income from that property then gets added back into your surplus capital, allowing you to spin the flywheel even faster. Or perhaps you use it to start a side business, which becomes a second cash generation engine. The key is that you are now using the profits from your capital to acquire more cash-generating assets. This is the essence of the Berkshire model. You start by building capital through savings, you let it compound in a low-cost hub, and then you use the mature capital base to buy or build new sources of cash flow. This creates a system of ever-increasing financial power, a personal flywheel that, once it gets going, is almost impossible to stop. What is the antithesis to this disciplined, systematic approach? It's the feast or famine cycle, the path followed by the 99% of individuals and businesses who never achieve financial escape velocity. This path is characterized by a lack of system and a failure to reinvest. For an individual, it looks like this. They get a good job and start making decent money. They save a little, but without a clear system. When they get a bonus or a raise, instead of using the entire surplus to push their flywheel, they engage in lifestyle inflation. The bonus goes towards a lavish vacation, the raise goes towards a bigger apartment or a more expensive car payment. There is no reinvestment loop. Their savings rate stays stubbornly low, even as their income grows. They might dabble in the stock market, but it's more like gambling than investing. They chase hot stocks they heard about on the news, buy high in a frenzy of FOMO, and then sell low when the market panics. There is no consistency, no long-term vision. They are constantly stopping and starting, pushing their flywheel 1 inch forward, and then letting it roll 2 inches back. For a small business, the cycle is similar. The business has a great year and generates a healthy profit. The owner, instead of reinvesting the majority of that profit back into the business to improve systems, hire better talent, or develop new products, pulls all the cash out to fund a lavish, personal lifestyle. They buy the fancy car and the big house. The business is starved of the very capital it needs to build a durable competitive advantage. The next year, a new competitor enters the market, or the economy takes a downturn. The business, having failed to reinvest and strengthen itself, is now vulnerable. It struggles to make payroll, and the owner is forced to inject personal funds back in or take on expensive debt just to survive. They lurch from one good year to the next crisis, never building the momentum that leads to true, sustainable success. This is the path of financial fragility. It's a life of running hard just to stay in the same place. It is the direct consequence of failing to understand the power of a systematic, reinvestment-focused flywheel. The very engine that Buffett has used to create one of the world's greatest financial fortresses. The direct financial connection of the flywheel effect is the exponential growth curve it produces on a balance sheet. The numbers are almost difficult to comprehend. Let's chart the growth of Berkshire Hathaway's book value per share, which is a good proxy for its intrinsic value. In 1965, when Buffett took control, the book value per share was $19. For the first 10 years, the flywheel was just beginning to turn. By 1975, it was $94. Good progress, but not yet earth-shattering. The next 10 years, the momentum built. By 1985, it was $1,300. The next 10, it accelerated further. By 1995, it was over $11,000. The flywheel was now spinning with incredible force. By 2005, it was over $60,000. By 2015, it was over $155,000. Today, it is in the hundreds of thousands of dollars per share. This is not a straight line. It is a curve that gets steeper and steeper over time. This is the mathematical signature of a functioning flywheel. The growth in the later decades is exponentially greater than the growth in the early decades. This trajectory is directly correlated with the growth of Berkshire's insurance float. As the float grew, it provided more capital for investment. The successful investments increased the company's net worth, which in turn allowed for the generation of even more float. You can lay the chart of Berkshire's float growth directly over the chart of its book value growth, and they will tell the same story. One is the fuel, the other is the velocity. This is the ultimate financial payoff. It's the difference between linear wealth creation and exponential wealth creation. Most people's financial lives are linear. They trade their time for money, and their net worth grows in a straight, predictable line. The flywheel model, fueled by a float-like structure, creates an exponential curve. It creates a system where your money starts to do the heavy lifting for you, where the growth in the 40th year of the plan can be greater than the growth of the first 20 years combined. This is the final promise of the Buffett philosophy. It's not just about avoiding debt to be safe. It's about building a resilient, self-funding machine that unleashes the awesome, world-altering power of long-term compound growth. You have just spent this time investing in a profound upgrade to your mental software. You have moved beyond the simple, surface-level advice of debt is bad, and have internalized a sophisticated, multi-layered framework for thinking about risk, capital, and resilience. You now understand the deep psychological reasons why we are drawn to leverage, and the disciplined mindset required to resist that pull. You have a practical blueprint for analyzing debt in your personal life, in your investments, and in your business. Most importantly, you have unlocked the secret of the Berkshire Hathaway empire, the genius of using insurance float as a source of capital without the risk of ruin, and the unstoppable power of using that capital to spin a flywheel of perpetual growth. This is not just trivia about a famous investor. This is a complete system of thought for building real, lasting financial freedom. It is a mental tool that, once acquired, will change the way you look at every financial decision for the rest of your life. But understanding the engine is only half the battle. You now know how Warren Buffett gets his capital, the lifeblood of his operation. You understand the float engine. But a powerful engine is useless without a brilliant driver who knows exactly where to go. The other half of the equation, the piece that connects the fuel to the destination, is his legendary process of capital allocation. How does he decide where to invest that $160 billion of float? How does he calculate the value of a business like Coca-Cola or Apple? What are the specific non-negotiable criteria a company must meet before he is willing to write a multi-billion-dollar check? That is the missing link. It's the other side of the coin. The video that is now on your screen is designed to be that missing link. It is the next piece of the map. Think of what you've just learned as the foundation of the fortress. That next video is the blueprint for the towers, the strategy for deploying your forces to conquer new territory. The journey to mastering this way of thinking is a process of assembling these powerful, interconnected mental models. You have just forged a critical piece of your arsenal. But the true power comes when you link it to the next. The choice is not simply to watch another video. The choice is to continue your ascent. It is to decide that you are not content with being a passive observer of financial success, but that you are committed to becoming an architect of your own. Complete your arsenal. Click on the video and master the art of capital allocation.